I think every company is just going bankrupt. Just look at the Nasdaq. This is a 1 hour chart from the peak a few weeks ago. Peak to trough down a whopping 9% in 3 weeks, with both weeks last week and this week being down 3% alone. Now, I just like to joke about the bankruptcy when analysts or investors are overreacting, in my opinion, on news or earnings. And dependent on the PCE data that's coming out later this morning, we see a small bounce in the market. But in this video, let's see where this came from, what will be most impacted, and where the market has this all wrong. At the end, I will also give comments about a company I have sold in order to buy another. Now let's dive straight into what happened this week, and well, let's see if the bankruptcies are gonna end. Of course, I don't mean that companies are going bankrupt. This is just a joke I like to make when I think investors are overreacting, but in order to see why they are overreacting, well, that might be a good thing to start with. So we have to go back to July 11th, so a small rewind of about 3 weeks. And what happened was that we saw the first data coming in, which suggested a macro shift. We saw what was at the time seen as a rotation out of the large caps and basically AI, big tech, and into the small caps. Because what happened was that we saw the inflation rate at a month-over-month basis come in at minus 0.1%. And the initial jobless claims come in at 222,000, where 236,000 was expected. Now, what this caused was an inflection where we projected to have rate cuts at the end of the year at the December meeting. And this is now shifted all the way forward towards September. Basically, investors are certain we are getting a rate cut in September. And this started at this data release. Now, after this data release, what we saw was Nvidia, I'm going to say, collapse by 5.5% on July 11th. And then 1 week later, on July 17th, it was down another 6.6%. But this was due to the ASML earnings. Now, I made a video about this last week, or 2 weeks ago, where I explained what happened and what the issue was with ASML. But that's 2 weeks in a row where the markets are getting hit quite hard. ASML was down 12.7% that day and basically dragged the entire chip sector with it. Whatever we can say now, this may have been a topping signal. Now, when we look at the market shift that has happened this week, then we have to go back to the earnings earlier this week. Because we saw Google and Tesla report earnings, and basically the day after, everything fell apart. Now, not completely, but to some degrees it did. Because what happened was that Google reported earnings, and these earnings, they were quite good. We saw revenues up 14%, or at a constant currency, 15%, with operating margins of 32%. The operating margins went up. Net income went up by a lot, and diluted EPS. Well, that also looked very good. These earnings from Google were really good. So what happened? Now, in order to understand what happened, we have to look at the comments that were made during the earnings call. Because here we have one. And what they said was, year to date, our AI infrastructure and generative AI solutions for cloud customers have already generated billions in revenues and are being used by more than 2 million developers. Okay, Google, that's fine. What's your revenue from it? Because up till now, we see a lot of AI investments. They're getting more efficient. We see a lot of earnings growth, but we don't see revenue growth. Or at least nobody seems to be able to say this amount comes from AI or us. The only thing we see is, no, we make money for customers. No, it helps with efficiency. That's fine. But with all the billions being pumped into this, what is in it for you? And to give you a general understanding of how much money is getting pushed into these projects, they also said, or they didn't say, this was somewhere hidden in their 10Q report. During the 6 months ended June 30th, 2023 and 2024, we spent 13.2 billion and 25.5 billion on capital expenditures, respectively. So year over year, they almost doubled their capex. We expect to increase, relative to 2023, our investment in our technical infrastructure, including servers, network equipment, and data centers to support the growth of our business and our long-term initiatives, in particular in support of AI products and services. So you're gonna double your capex, push 13 billion into it, and the best comment you can make about it is, we've generated billions in revenues for our customers. okay, Google, we want you to make revenues. So the earnings were good. Don't get this wrong. The earnings were very good. They missed a bit on the YouTube ad revenue expectations. But other than that, they seem to do really well. However, we want to see revenues from AI. We want to see these investments pay off, not just in efficiencies around the business, but in, well, pinpoint to us where those revenues are made for you. That's basically the signal I'm seeing from investors. Now, then we also had Tesla, and Tesla also reported earnings, and what we saw here was different but the same. We saw decent earnings from Tesla, about as well as you can expect in these quarters, and they made some AI comments. They made comments on Nvidia, and what they said wasn't that particularly good, nor bad, but not specifically good for Tesla. So let's first look at the earnings, because there were a couple of things standing out. Now, the total automotive revenues were down 7% year over year. We know it's very difficult to sell cars. High interest rates, we know the story by now. We saw total GAAP gross margins go down 23 basis points from a year ago, and they're now at 18%, slightly up from the last 3 quarters. So that is good, I guess. We saw income from operations down and operating margins also down to 6.3%, a bit up from last quarter, but quite a bit down from a year ago. Now, then we had another thing before we go to the AI. The cash and cash equivalents, they were up about 4 billion, but they had free cash flow of 1.3 billion. So what does this mean? They took out debt. What they did was they got on some extra loans probably, and they raised all the cash balance that way by taking on debt. Not really good, but when you took out all the expenses they had to fulfill, all the requirements, they didn't have that much cash after last quarter. So it might be a good thing they did, but they do have some more debt now with probably not the most attractive interest rates. Now, if we look at this slide from the Tesla earnings, I want you to look at the production numbers and the deliveries numbers, because this is something they did really well. They were down, or the production was down 16% year over year, and quarter over quarter, even by, well, I guess slightly less. Okay, about 10% down quarter over quarter on production, but they did sell a lot more cars than they produce. This is something they did very well, because last quarter they had a lot of overproduction. So now they just pushed the production a bit down, sold a bit more cars again. That's all good. So then, what is the point I'm trying to make, and why Tesla contributed to the, I'm going to say, AI crash so much? Well, basically, it were these comments, because what we see here is a question for an update on Dojo. And I've outlined the important part in this answer. And what he said is, I'm quite concerned about actually being able to get steady out Nvidia GPUs and when we want them. So he doesn't expect them to get GPUs when they want them, because the demand for the Nvidia chips is so high. So what he said is, and I think this therefore requires that we put a lot more effort on Dojo in order to ensure that we've got the training capability that we need. So what he is saying is basically that he doesn't want to rely on Nvidia to give him the GPUs he wants when he wants. And that might not be so great for Nvidia, because that means that Tesla might go shopping elsewhere, or, well, in the case of Tesla, that he will just take a look at his own project once again. But for other companies, that might mean that they will go shopping elsewhere, or maybe just delay the updates. That's not really what you should want as an Nvidia shareholder. Okay, so where do I think investors get this wrong? Well, one, I think a bunch of companies are expected to make revenues from AI that you shouldn't expect to make revenues from AI. What I see in my stock list is when Nvidia drops a bunch, it might take Monday down a bit as well. Now, Monday has some AI features for their customers. However, they are not an AI company. They simply aren't. And I think that investors should make a distinction with that to see which companies truly benefit from AI, don't have to do the investments that Google has to make in order to service others with it, but can use it for themselves. Now, of course, if AI is to sell off as much as it is doing right now, then that distinction will not be made in the foreseeable future or in the coming few weeks. However, maybe after that, I hope to see a bit of a disparity between the two and see a bit of, well, switch in directions. I think that can happen, and I think you might want to look at it. I have a few companies on my watch list, for example, that well, they will benefit from AI. They will benefit in the economics for themselves of AI, and they never claim to have done any AI projects for customers. Now, in a video that I will make probably later next week or the week after, I will go through my watch list and I will explain to you why I have them on my watch list, what I see in them, and maybe I can pinpoint then and there which companies I look at, which should benefit from AI, but not in a revenue generating matter, but they can generate in it on a profits basis. And that's the company I think are most attractive. Just like Nvidia, they do generate revenue from it, but also a lot of profits from it. Now, as I explained to you, I have sold a company in my portfolio. And I can be very simple about which one that is. And that's Moody's. Now, why did I sell Moody's? Because if interest rates are coming down, that should mean that companies will start to, well, issue more debt, and that debt needs rating. However, when we look at the chart of Moody's, we can see that after the earnings report, it didn't do all that much. And I thought it was a fantastic earnings report. Now, the day after, with everything going down, the Moody's was also dragged down quite heavily. This was the day before yesterday, and I decided to sell the business. I did this because another company I had my eye on, and I really had my eye on, that was selling down as well. And I think Moody's is very expensive. I think that company went into quite good of a value range. Now my portfolio, the grown quality portfolio, is still very, very small and nimble. So this basically allows me to just switch up and switch positions whenever I feel like it. Now, of course, you want to give companies time to work their ways, but I was decently into the green on Moody's. I think I was up 15% in a maybe 3 months at most. So I think the returns were quite good. And well, basically, I decided to sell because, well, basically, EPS beat, revenues beat, guidance beat because they upped their guidance. They upped their full year guidance. So it's a triple beat. And somehow the stock didn't really move, like it was all priced in already. Now, if we look at the guide upgrade, we can see that revenue growth was expected in the high single digits to low double digits. Now low teens range. Operating expense, mid single digits to high single digits. Okay, that moved up to the high single digits. So operating expenses did go up slightly, but adjusted operating margin went up. Diluted EPS up. Adjusted EPS up. Share repurchases from 1 billion to 1.3 billion. Free cash flow from 1.9 billion to 2.1 billion to 2.2 billion. So they basically upped their guidance across the board, and well, okay, they upped their operating expenses slightly as well, but not that much. And basically this made me nervous, because when I see a stock that doesn't perform on earnings as well as I thought it would or should, then I want to be able to pinpoint where this is happening or why. And I wasn't able to. Now you can say, okay, that's fine, just move on. The stock will go up if it's a good business, which Moody's absolutely is. There's no doubt about it. However, it made me nervous. And like I already explained, grown quality portfolio is still very small and nimble. So if another stock is trading down to a level that I really like it at, then why not buy that company? I mean, I don't have tens of thousands of dollars in this holding. It was the smallest holding in my portfolio. So why not just switch it out? I still have S&P Global, which I presume I better understand if I'm not able to pinpoint where this earnings went wrong. And, well, what did I buy for the money? Well, I bought Duolingo. I really like this company, not just because of the brand, because of the happy all. Now, I think Duolingo is a true AI company. And that might sound really weird because it's a language app. And in a future video, I think I will release this next week, I will go completely into my thesis of Duolingo, why I like this company as much as I do. But for now, it's just, I wanted to tell you that I bought Duolingo. I'm really impressed by this business, by the growth, what they are doing with AI, and well, the growth prospects I have for this business. Now, if you want to know my thesis for Duolingo, make sure to subscribe to my channel so you will see when I upload that video. And if you agree with me on the AI thesis, just let me know in the comments. For now, thank you for watching, and I hope to see you in my next video.